When I saw that Paul would be joining me this week on Market Talk Monday, I thought the timing could not be more perfect. Now with talks of possible US recession, a modest one, a persisting inflation, and decreasing housing affordability, and of course we talk about supply chain issues that we can actually see just as every day in our everyday lives, visiting a grocery store and seeing some empty shelves there or quantity limits on items that we can purchase just as customers. I think there's no better person that I would like to get a macroeconomic perspective with a fourth industrial revolution and America 2.0 future forward point of view than our very own Paul Mampilly. So hello, Paul. Thank you for joining me today, all of us today here on Market Talk Monday. Good to see you.
Thank you for that awesome introduction, Amber. I am thrilled, stoked to be here.
Yes.
And you've got some lined up, some tough questions for me. Amber, no more mercy for Paul. We're going to ask Paul the tough questions. So, hey, let's get to it, because you know what, Amber, for us to be useful to folks,
yes,
rather than just telling them, stuff to hear, hey, let's answer questions that we know you want answers to. So, you sent me them in advance, but that doesn't necessarily help me because these are some tough questions. Okay. But let's go. But before I do that, Alex back there, how are you, friend? Alex, our Zoom buddy, our mascot for our publishing company, which is called Bold Profits. Check into us as well. It's a way of supporting us. But let's get to the questions.
Okay, Paul. So here they are. Question number one. Okay, so Fannie Mae actually is forecasting a modest recession for the U.S. economy, and they actually believe that the house buying frenzy that we're seeing right now will begin to fizzle somewhat. So I'd like to get, what is your take on this, and what is your forecast from our perspective, from an America 2.0 type perspective?
Right. So, I didn't read the Fannie Mae prediction, even though I'll probably get to it. It's probably sitting in my burner email account because I belong to their email inform folks that we told you that this housing boom was coming, because we told you that the millennial generation is coming of age. And when people come of age, they go and buy houses, they buy cars, they start to have families. And we also equally told you that as a result of the 2008 crisis, we had not put up enough houses for really 10 or 12 years. I think the regular rate should have been somewhere in the millions, but I think there were several years after 2008 where we put up under 1 million houses. So we are incredibly under inventoried in terms of housing. So that's the first thing to think about, which is that we simply do not have enough houses relative to the demand that is out there, which is absolutely massive. Go speak to folks that are in their mid 30s, late 30s, early 40s that are out there looking, and they will tell you, I looked at 4 houses and there were 20 bidders.
Right.
And then the price just got so crazy that I just couldn't do it. And now with mortgage rates having gone from 3%, just literally 6-9 months ago, to 5% plus.
That's right.
I have read reports that the average mortgage payment now is higher by as much as $500. So $6,000 per year. So going back, I'm not escaping what you asked me. So $6,000 more per year. Many people are going to be at the very least say, hey, well, I need to reconsider my housing purchase. But it doesn't change the underlying dynamics that are still in place, which is that we still don't have enough houses. We just don't have enough houses. And that's going to be true for the next 5 or 7 years. And that's really what's driven, as you put it, the housing frenzy. In other words, why have prices rocketed up? Well, it goes back to the going upness theory of life, which is that if you have way more demand and not enough supply, the way that the market, which is nothing other than people coming to pay higher prices because they want a house that fits their standards. Well, the market adjusts by moving the price higher, which then incents homeowners to potentially sell, home builders to build more, other people to come and push inventory into the market. So this is the market setting mechanism. High prices draw supply in which now will come to meet the demand. And so we are seeing probably some amount of weakness that is going to come as a mix of various things. Probably in the short term, 1-2 years, we've probably seen some kind of peak in terms of pricing for many parts of the country, but not all. I can say personally that where I live in North Carolina, we are seeing a massive number of people move here. And despite my city, Durham, really being reconceived, I mean, there are apartment buildings, townhouses being built everywhere. And you go an hour outside, there is just clear cutting going on of land. We have a lot of land here, but still the amount of development is huge. So that is all supply that is going to come online over the next 3, 6, 9 months. And that's going to be still soaked up by all the people that want houses. So Fannie Mae is likely right that housing prices, they can't go up at 30% every year. It's just simply not mathematically conceivable for that to happen. And high mortgage rates will definitely slow some amount of demand. The inflation in building materials has also driven the price of new buildings up in particular. That will also have slowed demand. And we've also just got a lot of supply that has begun but not yet finished as a result of something you mentioned that's in a future question, which is some lots of limits in terms of what you can get in terms of building materials. There's still some amount of supply shortages out there. But bottom line, we still need millions of houses. We still need millions of houses really to meet the demand profile that is out there, because we've got more and more millennials entering that period of time where they want to buy a house and they're going to buy a house. So any weakness will be, in my judgment, fairly small, and nothing that is happening is going to change the ultimate demand and supply balance, which has really been in the making for a decade plus. So yes, Fannie Mae is probably right about the housing market. Now, in terms of a recession, a recession is defined by 2 consecutive quarters of negative economic growth. That is the official definition of it. Will that unfold? I did some work over the weekend and I posted a note on Twitter written by Gary Schilling, who talked about the fact that in normal times, okay, I'll redefine it, pre-COVID times, our economy is 70-30 in terms of services. 70% of the consumption expenditure is in services. So when you travel, you go to a hotel, you get on a plane, you go to a restaurant, you go for entertainment to Disney or wherever you go, that's all services. And our economy being highly developed, pre-COVID was 70% in services. Now, that balance shifted huge in 2020 as we went through lockdowns and we went through a goods buying bonanza. I mean, a complete bonanza, because we were at home, but we still had internet and we still had our credit cards. And we just went on Amazon and on Etsy and on Wayfair, and we just bought the store out. And we bought the store out. And that article by Gary Schilling says that in all likelihood, and it's going to be proven out, I believe, over 2022, we have way too much inventory. Way too much inventory. We have too much inventory sitting on ships that are still waiting to be unloaded, 60 plus ships off California that represent, again, secret inventory that's sitting out there. The docks are full. I actually drove by Richmond this weekend and their docks are full. The warehouses are full. We're still having clearly some amount of trouble getting some of these goods to the actual shelves, but we have massive pipeline of inventory, and more is coming. And more is coming because retailers, having experienced out of stocks, people being unhappy, lost sales, have overordered by a factor, some estimate by a factor of 2 or 3. And as that inventory is coming in, we're about to experience a goods demand slowdown as a result of higher prices. Will that cause a recession? Well, if the services part of the economy normalizes, I'm betting that we stay out of a recession, or if we do, it's going to be marginally negative. But I would bet that people planning to travel, do things, if we revert and we have a bit of a services boom, it will offset a goods decline, a goods recession, and we will have a break-even economy, maybe a 1% growth or maybe a negative 1% kind of recession. It won't feel like a full recession, but definitely all the folks that benefited from all that lockdown spending, those folks are going to be in a recession. There's already a freight recession that is unfolding. You're starting to hear about any number of stores, places that take in excess inventory, like TJ Maxx, I think, is a place where you get excess inventory. They're just being flooded with extra goods. So there's also a mismatch going on of what was ordered 6-9 months ago and what is being demanded now is quite different. So long story short, yes, there is a possibility of a recession, a mild one. Fannie Mae is right. In all likelihood, housing prices are likely to, at the very least, see a slowdown in terms of price gains, which all the home buyers will rejoice at. We're going to see some more supply. But because of the millennial generation and Gen Z being out there as still increasing spending, increasing consumption, getting raises, they're still going to be out there as a very strong force, keeping our underlying economy strong.
Okay. I thank you for giving me that perspective, macroeconomic perspective, Paul. So from my point of view, I'm going from a layperson investor, what do investors in your America 2.0 types of investments do now? What should be their top of mind agenda right now, and where A20 investing is concerned?
I think the top of mind thing is to have a BOP mindset, a bullish and optimistic and positive mindset, because we have in the stock market is right now being ruled by people who have the opposite mindset. They are off the viewpoint that the world's about to go to hell in a handbasket. And that what you should do is hunker down and buy into things and prepare for the end of the world as we know it. Now, we think that is wrong. We think that's completely wrong. We think it's utterly wrong. And those folks who have been setting prices for 6-7 months now, in other words, at any given time, Wall Street prices can be dominated by different groups of people. And the folks that have been dominating the price setting mechanism on Wall Street have been macro hedge funds, macro traders who don't care about sales. They don't care about revenue. They don't care about anything. The only thing they have been trading on is what are interest rates going to go to and what's the data tell us. And for them, data is backward-looking data, looking at some sort of statistical models. They're all backward-looking, doesn't project the future, doesn't think that you go through different periods of time. You do have to match the scenario to the data. And so they're short. They're short. And by short, we mean that they have made large, very large bets that our markets are going to go down and our stocks are going to stay down forever. So we have our stocks across our service. I mean, we have really experienced a brutal beatdown. I mean, stocks with 30% of their stock market capitalization in cash have gone down by 50, 60, 70, 80%. They are trading for 1 and 2 and 3 times sales. That's the price stocks trade at as if they're going to go bankrupt. But just remember, they've got 30, 40, 50% of their total stock market value in cash. These folks are not going bankrupt. Then on top of that, they are growing their sales by 20, 30, 40, 50%, or even more. And yet these so-called wise guys that are out there, these macro traders that know everything, are like, no, no, no. Our data says that these stocks are supposed to go down if interest rates go up. And you know what? We are going to short them and we're going to stay short. In my opinion, Amber, this is really one of the greatest opportunities in market history. I mean, things, if you go and look at these companies and you go, what? Palantir is telling you they're going to grow at 25 to 35% for the foreseeable future. You can go look at company after company telling you we only have for the foreseeable future growth ahead of us. This is going to reverse and it's going to be historic. It is going to be huge. They will write articles about this. How could have all the experts been so wrong? And you folks, you know, the experts have gotten pretty much everything wrong pretty much over the last 10 years. I mean, name one thing the experts have gotten right. I mean, the experts weren't right in 2008. And they're telling you that high interest rates are bad for our stocks. Meanwhile, our stocks have cash, have amazing businesses that are transforming the world. They trade at dirt cheap prices and they have growth, and that growth is accumulating. So I would say, be strong hands. That's what I would say. Be strong hands, be BOP. Our time is coming and our win is going to be huge, I mean, you will be able to say, hey, I was one of the big winners. I got this right. And we are going to be so proud. We're going to win and it's going to be awesome. So that's what I would say. The turn is coming. And it's going to be big, and we're going to win, and we're going to win big.
I love that, Paul, because we are looking forward to the turn. So my last question to you, I know that you're following really fantastic future forward megatrends. So based on our discussion today, what megatrends do you think that in general that we should really be focused on where housing is concerned, possible modest recession, and supply chain economics is concerned?
Well, the one thing I didn't say is the modest recession is good for us because it means that the Federal Reserve, which says it's which the market has priced as raising interest rates 11 times. Yeah, not going to make it. They're not going to raise interest rates 11 times. I mean, it's not possible. With an economy that's going to be growing at 1% or even a negative 1%, they're not going to do it. So we're going to have, I don't know, if I were to guess, maybe 3 interest rate rises on the low side, maybe 5 on the high side, which is, half of what is already priced into the market. So people anticipating weakness in a recession is good for our stocks, because remember, the underlying theory as to why all these wise guys have gone and shorted all our stocks is that interest rates are bad. Rising interest rates and high interest rates are bad for growth stocks. So obviously then lowering and low interest rates would then be good, and you would have them come and cover shorts and bid them higher. But that would just be the first wave of buying. And then there would be, of course, everyone would now start to be like, oh, I've got to go buy these stocks. And they will start telling you what we are telling you today. It's tomorrow's headlines right now, which is that these stocks are cheap. They got a ton of cash and they're growing gangbusters. And people's like, I can't believe that, these stocks got this cheap. But for that, you got to have the conviction to be now. What's the one sector that I would absolutely focus on? I have to say that if I keep looking at what's going on, I have to say the greatest excesses of pessimism, which is where you want to buy, have to be in fintech. I mean, stocks like Coinbase, Robinhood, PayPal, Square, Affirm. I mean, they have been smashed, just smashed. And people like Warren Buffett and Charlie Munger are taking shots at them, saying all kinds of things. And I'm going to say that's the place I would be. I would make sure I own those and and have a basket of those folks. Don't just pick one stock, have a basket, because there is going to be a roaring reply that is going to rocket these stocks up. So that's my one single sector. If I'm put under the gun and say which one, I'd say that one.
Oh, that's good to hear. Thank you, Paul, for answering these questions. I call them dinner table questions. It's table talk.
Hey, dinner table is what matters. These are where the big decisions of life are made. Right. And people forget. People sit there and focus on all the supposedly smart money. But folks, it's all of your decisions that they're trying to work out. So what you're thinking, what you're doing, it matters. And Be strong hands, folks. Our time is coming and we are going to win big. Win big, BBOP.
Oh, thank you, Paul. We are BOP with you. So thank you for joining me on this Market Talk. Appreciate you.
Thanks, Amber.
Okay, have a great day ahead. So a big thank you to Paul for joining us on Market Talk Monday today. And if you're not yet a member of Paul's Profits Unlimited monthly stock investing newsletter, well, now's the time. Better time than never right now. So come join us and get Paul's latest recommendations and all investment forward-looking America 2.0 focus fourth industrial revolution type stocks. Simply click the Strong Hands icon right here over my shoulder to sign up for his stock research service without delay. So for about $100 per year, and sometimes less, depending on the sales promotion that our publisher is running, you can gain really fantastic access to Paul's America 2.0 stock picks and his way of thinking. So know that you can follow Paul and me on Twitter at Mampilly Guru and at A Lancaster Guru. We look forward to seeing you on Twitter, seeing you here on Paul's YouTube channel, the Paul Mampilly YouTube channel. And don't forget to please subscribe and like this video if you like the content. It does help support the channel. Give us a thumbs up. So until next time, everyone, take care. Bye-bye.